Hello and welcome to Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day. The central government has finally given its nod to convert Vodafone Idea's interest dues into equity. But about 16 months of delay has cost the already struggling firm dearly. In the September quarter, the telco lost 6 million subscribers. So will the government's lifeline be enough to pull the country's third largest telecom company from the quicksand of debt? This report has the answer.
Vodafone Idea Limited, a joint venture of Aditya Birla Group and the UK's Vodafone Group, has been losing consumer base for the last several months. In November, India's third largest telecom company lost over 1.8 million subscribers. It is crumbling under a debt of more than 2 lakh crore rupees, and it desperately needs funds. On September 15, 2021, the Cabinet had cleared a package for financially stressed telecom firms in which it offered them an option to convert part of the interest from deferred dues to equity. VIL has chosen to access this option. VIL's board decided to convert more than Rs 16,000 crore of interest liability payable to the government into equity. This will amount to around a 33% stake for the government in the company and will leave promoters with 50% share, but this was 16 months ago. The government also imposed one condition, that the conversion would happen only if the promoters of VIL, which includes the Birlas and the Vodafone Group, made a reasonable commitment to put money into the company. The government defended the move, citing VIL's failure to secure strategic investors and banks who could help it raise Rs 25,000 crore. The company could only bring in Rs 4,500 crores. The promoters allegedly took an ambivalent stand on the matter. They made it clear that they would not invest in 5G. The Birlas even said that they were ready to sell their shares at a nominal cost to a new buyer. And Vodafone plc publicly stated it would not make any additional investment into the company. After a prolonged delay, the union government finally cleared the long-awaited plan on Friday. It is only last week that the Birlas finally relented after a meeting with Communications Minister Ashwini Vaishnaw. They have now agreed to bring in money with other partners and run the management of the telecom firm. However, they have not committed to a number. Vodafone plc too has maintained a complete silence on the matter despite queries from the government. Meanwhile, apparently due to the delay in reaching a decision, VIL has lost 26.11 million subscribers, nearly 1/10 of the subscribers it had. In November 2022, its consumer base stood at 243.79 million, as compared to September 2021, when it was at 269.9 million. This was when the package was announced.
I think the government decision to convert Vodafone Idea's interest into equity has come quite late. And that has damaged Vodafone Idea's prospects quite a bit. But had this happened, say 10 months or 12 months earlier, things would have been quite different. Because in the process, in the course of things, Vodafone Idea has lost millions of subscribers. Its debt has piled up even more. And it has not done much on 5G.
The company's blended churn rate, which reflects the migration of subscribers to other network service providers, has gone up from 2.9% in FY 2022 to 4.3% in FY23. Its EBITDA margins too have been squeezed by 2.5 percentage points in the same period. What's more, VIL's losses have risen by 6.5% from FY22 to hit Rs 7,595 crores in September quarter of FY23. Yet, experts expect the path ahead will be smoother for the telco.
The road ahead for Vodafone is considerably simpler and less problematic than it has been for a long while. And I think there are two great advantages it has now. One is, of course, that its liabilities are considerably less. And second, that these liabilities have actually been reduced by government intervention.
However, experts believe that the government must do more if Vodafone has to survive and recover from the debt crisis.
Having demonstrated that it wants Vodafone to survive, it would be very crazy if the government was then not willing to go all the way in supporting its survival, at least in the medium term. I do believe that the government should do more, that government should think of combining the resources of BSNL with Vodafone. And because both have very specific resources that they can share with the other, and actually to the advantage of both.
Meanwhile, sources told Business Standard that VIL's immediate plan is to invest in increasing its 4G coverage to the level of its competitors. Secondly, VIL is also enhancing its network capacity. This is key because it will ensure the upgradation of its low average revenue per use, or ARPU. Also, a tariff hike from VIL seems inevitable. The company has publicly stated that there is a need to do so, and there is no doubt that it needs to push up its ARPUs quickly. The telco is also expected to push its digital strategy with expectations of tying up with top players in key digital platforms in categories such as music, health, fitness, movies, gaming, etc. through its flagship app, Vi. But these future avenues are all dependent on how much money VIL will be able to raise. According to Goldman Sachs, VIL will have a cash shortfall of over Rs 64,000 crores by September 2023 at current EBITDA run rate.
The biggest challenge for Vodafone Idea still remains cash flow. It does not have ready cash flow. What government is offering in the form of equity is not going to do much. Vodafone will have to invest. So will Birla, the Indian partner, will also have to invest. Also, external investors will have to come in to put in fresh capital.
While experts believe that the government intervention has finally ushered in some relief for Vodafone Idea, the delay has done a considerable damage to the telco major's financial fundamentals. Moving ahead, the government as well as the promoters would have to take up a more proactive role in making the company attractive again for external investments.
Another debt-ridden and struggling entity was offered a fresh lease of life last year. On 27th of January 2022, Salt2 software conglomerate Tata Group took over the operations of Air India, which was on the verge of flying into obscurity. And now, as the takeover marks 1 year, how is the airline performing? Has it turned the corner? and what are the challenges ahead? Tariq Ahmed's report has all the answers.
In the winter of January last year, Air India was warming up to the idea of a new owner and to a big change in its work culture. For the airline, it was a homecoming of sorts as it was rolling back into the hangar of mighty Tata Group, which once floated it before losing it to the government. And for the government, it was a big achievement as it was getting rid of the cash-guzzling airline. And then the moment arrived. January 27, 2022 may well be the big turning point in the airline's history. It was the day when Tata Sons chairman N. Chandrasekaran met Prime Minister Narendra Modi and formalities to hand over the control of the airline were completed. Old members of the board gave way to the new ones. The sale was sealed for 18,000 crore rupees. The government had settled the 61,000 crore rupees of loan before selling the airline. A year on, Air India is flying high. On January 27th, it listed plans for the second year, while its CEO Campbell Wilson said that taken together, the progress over the last 12 months has been nothing short of stunning. But last year was not easy. When Tatas took over the airline, it was fraught with several problems. Mismanagement, poor passenger services, and bureaucratic grips were choking Air India. Competitions from efficient, low-cost airlines like Indigo and increasing fuel price were also making the situation worse. But Tatas seemed to have overcome the hurdles. After 1 year under the new management, things have started to look positive. Highlighting the achievements, Air India CEO Wilson said that the number of operating aircraft in the past year has increased by 27% and is at 100 now. Wilson also said that the number of daily flights has increased by 30% and weekly international services have risen 63%. Air India has narrowed down operating losses from 7,000 crore rupees in FY22 to 2,450 in this calendar year. In December 2022, Air India had a standalone passenger revenue of 3,100 crore rupees, which is the highest ever Air India recorded. Air India has achieved the increased revenue mostly by making the existing resources more efficient. Better management has helped Air India to increase the yield from international flights, and it was able to hire talents from rival airlines last year. The multiple steps that have been taken to bring down the cost also played a major role in the recovery. Performance-linked incentives for travel agents and introduction of new software for revenue management gave the 3,100 crores record standalone passenger revenue. Air India's market share in the domestic market was 8.7% last year. Combined market share of AirAsia India and Vistara, which was under Tata Group and Air India, is just about 26%, while Indigo Airline has a massive share of 56%. In a booming domestic market which saw a 47% increase in passengers in 2022, Air India is aiming to secure 30% of market share. In the international market, 80% of the flights to and from India are by international airlines like Emirates, Qatar Airways and Singapore Airlines. Air India's market share in international fleets is just 12% at the moment. By merging Vistara Airlines with Air India and AirAsia India with Air India Express, Tata Group is looking forward to increasing their market share. Currently, Air India and Vistara are the only long-haul carriers from India. Also, it was reported that Air India is likely to order 500 new aircrafts, which include both the narrow and wide bodies aircrafts. But what are the challenges ahead?
Adding a fleet and modernizing a fleet is one thing, but resolving the way the government organization, working system, and machinery that is Air India, those systems, processes, and ways of working have to be changed and migrated, and therefore it's extremely important for the new management, including the CEO, to take those steps and resolve it.
As a capital-intensive industry, modernizing the fleets and using the existing aircrafts to maximum efficiency are crucial for Air India.
Aviation industry is a very capital-intensive industry. We call it as a, everyone keeps calling it capital-intensive, but in reality, what it means is that you need to continuously invest capital, and a large part of that capital actually goes in fleet modernization. That's extremely important. And with Tata's coming in, I think it was very clear that they would have that kind of capital that would be required for Air India. So if you see Air India's turnaround, it's actually not surprising. I mean, it was bound to happen the minute it was privatized. Why? It has got some of the premium slots at the international airports, which are a high yielding sector. If you look at their cost structure, their cost structure was basically marked down significantly because of the number of aircraft which were not operating.
But is there any other challenge?
Turning around is not the challenge when you look at Air India. Sustaining that turnaround is the challenge. So when you were so bad, if you are at 0 and you suddenly achieve 1, well, that's anyways a great 100% improvement. But that consistently being able to achieve that growth, that is where the test of the management of Air India will come in.
Despite the big turnaround, the airline needs to address the legacy thought process across the company. The alleged late response to the recent urination incident highlighted this. So speedy migration from the work culture of the previous organization and sustaining the momentum will be the challenges for the airline.
Moving on to markets, the crisis engulfing Adani Group led to a panic sell-off in bank stocks. Investors dumped shares of the pack as they are worried about debt repayment by the group. And this comes despite the RBI's assurance that the Indian financial sector was stable and resilient. In our next report, Nikita Vashisht explains why analysts think it may be a good time to start buying the dip.
The financial allegations leveled against one of India's wealthiest men, Gautam Adani, have shaken the confidence of the investor community. Last month, US-based Hindenburg Research said it held short positions in the group's securities as they expected 85% downside in them. The short seller's assumption was based on its research findings, which alleged that the Adani Group indulged in improper use of offshore tax havens and stock manipulation. It also raised concerns about high debt and the valuations of the 7 listed Adani companies. Since the release of the report, the crisis engulfing Adani Group has percolated to broader markets, especially banks. Investors have booked profit in the pack as they grew increasingly worried about the group's 2.1 trillion rupees debt. On the bourses, the Nifty Bank Index dropped 3% on the National Stock Exchange between January 24 and February 3. The Nifty Private Bank fell 2% while the PSU Bank Index crashed 7%. Individually, IndusInd Bank has shed the most, followed by State Bank of India, Bank of Baroda and Punjab National Bank. Analysts, however, believe the panic selling has been overdone.
The entire sector is not at risk for a couple of reasons. Not all the banks have lent to substantial amount to this Adani Group. B, if you relate to the net worth, we also worked out. I mean, it is not more than 5-6% of the net worth of the banking sector, this exposure. And as I mentioned in the first point, not all the banks have lent. So there could be 1 or 2 banks which have got a higher exposure. Maybe those banks could remain laggard, but not entire banking sector.
As per the Reserve Bank of India's assessment, bank exposures to group companies were well within norms. Moreover, industry estimates peg the entire sector's exposure at 80,000 crore rupees. Of this, 3 public sector banks account for nearly 50% of this exposure. Overall, global brokerage CLSA believes that Indian banks are funding 35 to 40% of Adani Group's debt. Meanwhile, valuations of listed players have eased considerably amid the persistent sell-off. As per data from Capitaline, SBI's price to earnings multiple has declined by nearly 300 percentage points to 11.39 times since January 24, while that of BOB has declined by around 200 percentage points to 7.6 times. Among private banks, IndusInd Bank saw the maximum ease in PE ratio by 125 percentage points to 12.76 times. Given this, A.K. Prabhakar of IDBI Capital believes it's a good time to buy related stocks.
The exposure is very low, and whatever the borrowing he has made, it is more of foreign funds. It is not about India. Okay, so I think exposure is very low. Bank of Baroda results came fantastic, sir, and their exposure is less than 0.5 also. IndusInd Bank has clearly said, they have very less exposure to them. RBI has given a permission to increase their stake till 26%. So there are many things like this which will not impact them. So I think selectively banks can be bought. HDFC Bank, IndusInd Bank, Federal Bank and Bank of Baroda is at top.
On Tuesday, a day ahead of the RBI's monetary policy outcome, the markets are likely to remain choppy amid news flow on Adani Group stocks and corporate results. With a 25 bips rate hike priced in, Deepak Jasani of HDFC Securities says investors would watch out if this would be the last hike before a pause.
So the hints they will look out for is whether this is the last in the series of rate hikes or there are still more of this to come. If they think inflation is going to be higher for some time to come, then it means the rate hike cycle is not yet over. So of course they will say about all these things. This is normal part of the policy statement. But the interpretation of these things would be whether rate hikes have come to an end or no.
Routes in Adani stocks spoiled the financial markets this party, which welcomed the provisions in the government's annual budget. In her budget speech, Finance Minister Nirmala Sitharaman had also announced a research and development grant for one IIT, aiming to encourage domestic production of lab-grown diamonds. The government hopes to reduce import dependency and increase employability. So what are lab-grown diamonds? We decode it for you.
Natural diamonds are formed in the Earth's crust under tremendous heat and pressure. Under these extreme situations, carbon atoms crystallize and turn into diamonds. Most of the diamonds are formed about 3 billion years ago. Some are recent too. Most of them are buried about 150 kilometers below the Earth's surface. Such naturally occurring diamonds can be mined only when they are transported close to the Earth's surface due to special magmatic eruptions. No wonder diamonds are such expensive commodities. On the other hand, lab-grown diamonds are chemically, physically, and optically identical to natural diamonds. They are produced in controlled environments like labs using extreme heat and pressure. The production of such diamonds takes 1 to 2 weeks' time. There are two methods for producing diamonds in labs. In the first one, known as high-pressure, high-temperature method, a diamond sliver is exposed to pure graphite in a chamber of 1500 degrees Celsius temperature and 1.5 million pounds per square inch of pressure. The second method, known as chemical vapor deposition, uses a thin sliver of diamond known as a seed diamond, is a sealed chamber that's heated to approximately 800 degrees Celsius. A carbon-rich mixture of hydrogen and methane is then pumped into the chamber. The gases are ionized, which breaks down their molecular bonds. This process continues over a few weeks, resulting in a larger diamond. In the 1900s, advertising company N.W. Iyer designed a clever marketing strategy for the diamond giant De Beers. This strategy made the diamond a symbol of long-lasting love. People started proposing to their loved ones with a diamond ring. But the environmentally conscious millennials are seemingly walking away from this tradition. They are worried about the environmental cost of diamond mining and have started to move towards considerably cheap, lab-grown diamonds. It is estimated that 250 tons of earth is moved to mine 1 carat of natural diamond. Some mines are big enough to be seen from space. Also, The cheap diesel that is used for diamond mining emits more carbon. Lab-grown diamonds are able to reduce carbon footprints as they are made in a controlled environment. Only 30% of the diamonds are used for making jewelry, and the majority of it goes to drilling, cutting, and grinding machineries. Diamonds are also used in windmills and automobile factories to reduce friction. They are also used as components in communication as it is the best semiconductor available. The cheaper lab-grown diamonds will spur its industrial use. According to the Gems and Jewellery Export Promotion Council, India witnessed a 54% increase in the export of lab-grown diamonds in 2022. Currently, these diamonds amount to only 10% of the total diamond market. The Union Budget has removed 5% import duty for the diamond seed, which the industry insiders have welcomed.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Lab-grown diamonds also go through the processes of polishing and cutting. So growth in this sector will not pose any threat to traditional industry. That's all for today. Guys, the next episode of the morning show tomorrow. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.